As a foreigner who came to Silicon Valley almost 20 years ago, I've often wondered what the tax implications are for foreigners. Folks having an H-1B or if foreigners buy real estate here in the USA, what kind of taxes they would be looking at. Today's guest is Jie Zhu, and she is a CPA with extensive knowledge on taxation for foreigners. She has been doing this for more than a decade and will shed some amazing light on how to plan your taxation and optimize your capital structure, not only for yourself, but also as part of your estate planning. I'm Charlie Yang. I came to Silicon Valley almost 20 years ago from Singapore to be a startup founder. And over the years, I developed a love for Silicon Valley's real estate, and I'm now a full-time realtor. Jie Zhu, welcome to the show. Thanks for joining me on my podcast.
Thank you for inviting me to speak. And so before I started with the real content, and let me give you a very brief history about the firm and myself. And our firm has been around since 1951 or 70 years. So we work with clients around the globe for both businesses and individuals. So the topic today is U.S. taxation overview for international investors in U.S. real estate in particular. So there are three major taxes applying to individual investors. So by the way, that today's presentation is more focused on individuals. Their institutions there are different considerations, but today's topic is more on the individual side. So the three major taxes applying to individuals are income tax, gift tax, and estate tax. Some of the countries have all three taxes as well. Some of the countries have one or two or just one. So it really depends on where people are located. But this is purely from U.S. perspective. There's a very important definition of residency. For income tax, and estate tax and gift tax, if you're considered U.S. resident for that particular tax purposes, then your worldwide income, worldwide assets will be subject to taxation. But if you are a non-resident for the particular tax purposes, then for income tax, it's only U.S. source that'll be subject to U.S. taxation. And if it's a gift and estate tax, and there'll be certain U.S. assets. And we are getting into a little bit details about how to define someone as a resident or non-resident, and you will see that definitions for income tax and for gift and estate are different, and also the definition of what are considered U.S. assets, even for gift and for estate taxes, are different as well. Definition of U.S. income tax residents, there are three ways to determine. The first is, of course, citizenship, and there's no argument, right? You're a citizen, and it doesn't matter where you live, and you are considered U.S. tax resident. And the second one is green card. And green card test that it can be tricky at times, but super majority of the times that with a green card, by default, you are U.S. income tax resident. Why I say it's tricky is in rare cases, and we have run into that, but it's not very commonly used, is by certain treaties, you may be considered non-resident for income tax purposes under the green card test. However, there's some other consequences. So this one is available, but is not commonly used. So generally speaking, if you have green card, you are considered income tax resident by default. And the last one is substantial presence test, which will give you an example. Substantial presence test is really about your physical presence in the U.S. There are two layers of test. This is only available if you are not a citizen or a green card holder, and you're on visa. The first test is you are in the U.S. at least 31 days during the current year. By the way, that we use calendar year. So it's we don't use any fiscal year, so it has to be calendar. During the calendar year, you're here at least 31 days. Let's say I'm here only for 30 days. In that case, there's we don't go the second layer, and you're done. You're considered a resident for that year. Then the second test is that if you need the 31 days test, the second layer will be the 183 days. And how that works is we take there's three numbers we add together, and let's say we're considering 2023 as a tax year. We're trying to determine if you are a tax resident for income tax purposes. We take 100% of the days you're here in 23, plus 1/3 of days you're here in 22, plus 1/6 of the days you're here in 21. If the three numbers adding together is 183 or more, then you are considered the tax resident for income tax purposes for 2023. And just be aware that partial days here is normally considered full day. And let's say you got here like midnight or something, and it's only just like right before midnight, there's just like a few minutes, and technically that's considered in the calculation. Right. So just make sure that you're aware.
I come in and out of the U.S. quite a bit. Is there a way for me, if I come in and out of the U.S. Quite a bit, is there a way for me to check the number of days?
You are supposedly to keep track yourself, but I believe online that with the immigration and there's a way to see all your dates as well.
So by your definition over here, if I have an H-1B, but if I don't spend 180 days residency or 183 days residency in the U.S., I am technically speaking not a U.S. resident. Would that be correct to say that?
For income tax purposes.
For income tax purposes.
For income, yeah. So be very specific for income tax purposes. And
immigration is a whole different, it's out of the scope of this. But as far as income tax purposes, I can have an H-1B and I can be traveling all over the world and working for my Silicon Valley company. And technically speaking, I would qualify as not a U.S. Resident.
Okay. Yes, correct. So, for example, that the definition is actually super important, and which later on we'll get into a little bit about what's the U.S. source income, right? Because that's the why are we doing this test is because if you fall into this bucket of the definition, then suddenly your worldwide income is subject to reporting. Okay, right. So if you do not, then let's say I'm H-1B is probably harder from immigration perspective. You're really traveling a lot and not, right? But let's say if you are like L1 or other type of visa holder, and then you come here and for business from time to time, if you do not meet the substantial presence test for the income tax purposes, and what's going to subject to U.S. income taxation will only be the U.S. source income. So what are the general types? Like say, if you do get, like say, certain consulting income or salaries from a U.S. company for your performance of service in the U.S., okay, so that's considered U.S. source income. Or you have a U.S. rental property, and that's considered U.S. source income. Or you sold a U.S. Like real estate here. But if you say that I own Apple stocks, and as a foreigner, and I do not meet any of the residency tests for income tax purposes, in that case, that I sold my Apple stock, and the capital gain will be tax free, okay, for foreigners. So there are certain things, and but then we'll get into a little bit more about what's being considered under different rules. So the income tax treaty, I mentioned briefly previously. If as a green card holder, can the person be considered non-resident? Yes, and I'm using like the U.S.-China income tax treaty as example. There could be, but that being said, even if you meet the definition and like under or the meet the requirement under the tax treaty, and you claim as a non-resident under the treaty for income tax purposes, then just be aware that this 1 year you're claiming as non-resident for income tax purposes will not qualify as the the 5 years you need for qualifying for citizenship. That's my understanding, because my understanding is you need to be considered like resident for 5 years and right. And to apply for the citizenship. And if for any year that you're claiming as a non-resident under treaty is not part of that 5 years. Okay. And also we're not sure if this have any negative impact on the immigration side. So that's part that you really want to make sure if chatting with your immigration attorney, and so there's some coordination.
Okay.
The benefit from income tax purposes is good, right? Because a lot of our clients have foreign businesses and foreign assets. If they say, okay, I can be green card holder and at the same time claiming as a non-resident for income tax purposes, then all my foreign stuff, I don't need to pay U.S. taxes. However, just sometimes it's not just the tax consideration, and there's other things you don't want to impact your status.
Yeah, it becomes a huge deal, especially if somebody is a foreigner and they come here and they get their green card, and then it becomes a huge deal, especially for estate planning. The taxes are huge, for estate taxes. So that's why there's a whole bunch of people that gave up their green card and moved to Singapore because it's zero estate tax there. So, yeah, but.
Yeah, tax is always something that almost doesn't matter in which country, that there's always kind of like something people hard to wrap their head around. And
Yes.
unfortunately, that's the case. But that's why that you have attorneys and
Yes.
and professionals and who can help to do certain planning and to let me put this way, even though I'm in the tax business and I work a lot with clients on planning and stuff, and sometimes I want to say that tax is actually from a general planning perspective, is a secondary consideration. Why I say that is I'm not saying tax is not important. Tax is super important. What I'm saying is a lot of times we have different business purposes goals, and we have different family goals, and do not let the tax trump your other goals, and set your other goals. And first, the more that's have our priority, and then we can help from the tax perspective. Okay, in order to meet that goal, which cannot be compromised, and will be the the best plan to help you to go there. Okay, but do not say that, okay, we need to reach this tax goal and then let's go everything, compromise everything else just to follow the tax, and you may regret at some point. So that's what I want to say. So.
Got it. In short, basically, if somebody has money and they want to invest, to make more money based on that, they should plan that. But on the back end, the second consideration will be, hey, your tax. There are ways to optimize your tax payment, and that they should come to you or a person like you, and especially someone like you who understands the tax structure outside of the U.S., who has an intimate understanding of that, and also an intimate understanding of the tax structure in the U.S. can basically help structure something that will optimize, paying less tax.
There are different definitions for income tax and for estate and gift tax. And the three ways we said for income tax was citizenship, green card, and your presence here. However, for the definition for estate and gift tax are a little bit different. And essentially, we're looking at your intention here. And are you intend to stay in the U.S. forever? And where are you going to retire, and stuff like that, right? And where are you other connections like social, economic, and where your assets are. We look at a lot of different other factors. And so if you okay, let me put this way. If you're a citizen by default, then you are a resident, and not just by default, by definition, you are tax resident for estate and gift tax purposes. Again, there's no argument and no way out. But if you are green card holders, and there are room to make the difference. And if you're a green card holder, you live in U.S. and the assumption is that you want to stay here forever, and then you are considered a state and gift tax resident for U.S. purposes. And however, if you're a green card holder, you live abroad, and then you have like assets in a lot of other countries, and US is a small portion. Is it possible to make an argument? Yes. And we have a case recently that the taxpayer came here back in 2015 and got his green card and entered AP5 and for the whole family. And then that his goal, I met him back in 2017. That's our first meeting. At the very first meeting, he said, my intention is after I renew for the family, I want to give up because I don't want to stay here. And that was his intention, from the very beginning. But unfortunately, that 2020, the pandemic hit. And so another concept, and so just you guys know what's the background on this, on the considerations, is if you have had a green card for 8 out of the last 15 years before you gave up your green card, then you are subject to an exit tax. Yes, US tax you when you want to leave the country and we have an immigration status, but it does not apply to every single one of us, only for people who meet certain standards. And so if you have the green card and you, for the last 8 years before you gave it up, then you're considered a long-term, like the resident for this particular asset tax purposes. And how that 8 years is calculated is really any day during a calendar year where you have a green card is considered a full year. We see a lot of like individuals, foreign individuals, and owning the U.S. Rental properties a lot and enter their personal names. And if that really the profile of the client is that, hey, we're holding this one for just like 2-3 years, and then after that, then we want to sell it quickly. And then they're still in a or when the investors have no health issues, they're fairly young, and so in that cases, when we evaluate the risk, right, and for what estate tax purposes, it probably is lower because they're not intending to hold it forever, and the purpose was to sell it quickly in downstream for like just 2-3 years, and there's really no health concerns, there's no other concerns. In those cases that the risk is low, then can this work? Yes, maybe. Okay, so because from income tax purposes and that it could work out, that if they file the tax return, report all the rental activities, and with the depreciation and other expenses, the investor may not be paying much income tax anyway. But just be aware that the individual is exposed to gift and estate tax for U.S. tax purposes, and if they want to gift it to their kids, and they will be subject to gift tax. So just be aware. But if they're not, if no gifting planned, and they want to sell quickly, then this could work. But you do have to look at the risk. Other than the individual owning direct ownership, and one thing I didn't mention was that when an individual owning U.S. real estate directly, there's not much legal protection, asset protection. Other than that, you could buy, like umbrella insurance, like cover and stuff, right? And I've heard cases that where like homeowner, the rental property owner hired a contractor, and the contractor, the property the contractor working on is like a two-story apartment, and the contractor had someone working on that and turning down a lot of things, and then the person threw some of the construction waste from the second floor out of the window, and there's happened to be a pedestrian working like under the building at that point, and got hit and sued owner. And the owner at that point owning the real estate directly under her personal name. In that case, that her other personal properties, not just the real estate, and anything else under her name is subject to claim if there's a lawsuit and if there's a large claim. If the claims are beyond what the umbrella insurance can cover. So with the structure with LC, even without thinking of the U.S. Gift tax and estate tax, like purposes, that it provides good legal protection. So even from that perspective, we normally would recommend our clients, doesn't matter if they're U.S. or foreign, to have LLC holding the U.S. rental real estate. So from the income tax perspective, the really depends on how many members the LLC has. And if it's a single member LLC, let's say I'm a foreigner and I own 100% of the LLC and LLC own the U.S. real estate, right? In that case, 100% of the LLC activities will be reported directly on my personal income tax return. There's no separate federal LLC return in this case, but they're depending on the state. For example, if it's California, LLC, single member LLC, there could be a very, very simple state filing.
Cool.
But for the most part, that the LLC's activities are reported directly on the foreigner's U.S. income tax return. Okay. And so from a estate and gift tax perspective, the single member of that LLC is perceived as owning the U.S. real estate directly, because that LLC, single member LLC by default, is considered a kind of a transparent, disregarded entity for U.S. tax purposes, for all tax purposes. And essentially, you can just...
So there's really no point of having the structure in this way for estate purposes, basically.
Yes, other than for legal protection. It adds a legal protection, but it does not add any protection from the estate and gift tax purposes. Correct?
Well, technically speaking, the individual can sell his interest in an LLC to someone else and transfer the LLC to someone else. And the next question here is this: will the individual be subjected to capital gains tax?
Yes, of course. So it doesn't matter if you are a U.S. person or a foreign person and selling a U.S. Real estate, and in any way that will be subject you to the capital gain tax.
So what's the point of having a structure like that?
With a single member LLC in between?
Yeah.
It's more for the legal protection in this case. So this structure with the LLC in between versus the individual owning U.S. real estate directly is the difference is the legal protection.
So in your scenario, the person, the guy with the killer litter, basically can only sue the LLC and cannot sue the individual's personal
anything beyond LLC. Right. So the one caveat is one common mistake I would say is the single member commingle his or her individual assets with LLC assets, meaning that sometimes they may not setting up a separate bank account for the LLC, and instead the LLC is really just kind of like on the surface something on the books, but it's not really being used as a legitimate business entity running the real estate. So that's a big mistake. And when you commingle those two, if somebody's suing the LLC, they could say, hey, you never make the difference between yourself and the LLC. Therefore, that legal protection is out of the window. So do not make that mistake. If you put a legal entity in there, treat it as a legitimate entity and treat it as a true business. We talked about the little part of the slides is individual owning the single member LLC owning the U.S. real estate when you have like one single member, right? And the LLC could also have more than one members. And in that case, by default, that is a partnership. And in this case, that the LLC, when it has multiple members, it also has the option to be taxed as a corporation. So that's also a possibility. But generally speaking, that when individuals owning an LLC, owning a U.S. real estate, they choose to use the default form, which is a partnership. In that case, the LLC is considered a pass-through entity, meaning that the LLC will need to file in this case, a separate partnership return. Okay. and it reports whatever is activities. If it's a rental, then the rental income expenses, and it issues K1 to the individual owners. And the individuals will incorporate that K1, whatever showing on that K1, the income allocated to them, and for their own income tax reporting. So essentially, this is the LLC pass through everything below it and to the individuals. And then the LLC, again, does not have a federal level of tax. And if it's a California LLC or, certain other states, there may be state level of reporting and, certain fees associated with it. But there's really no LLC level of income tax per se. Okay. And so from an income tax perspective, everything passed through and being taxed on the individual tax rate. So there's no two layers of tax like in a corporation perspective.
And it basically goes out to the level of interest within the company. So if they own 30% of the LLC, they will be have to report based on that.
Yes, correct.
Okay.
And that's generally speaking is correct. And can there be certain special allocation? Yes, and that really depending on how the LLC operating agreement is drafted. Okay, we have seen the U.S. corporation. That's, if you remember, we mentioned that your single member LLC or your multiple member LLC can also elect to be taxed as a corporation. Okay, so that could also work in this case. And with the corporation, that there's a good legal protection, and again, that no commingle of your personal and versus the business. That's the caveat. And the U.S. corporation does need to file a separate tax return, and there are withholding tax on the dividends. Oh, by the way, that I forgot to mention on the previous slides. When you have a multiple member at the partnership, and if they're like foreign investors in that, the partnership does have withholding tax
30%
obligations for the profit that's applicable, not distributed, applicable to the foreign investors. And the foreign investors in that case, if there are applicable profit to them, then there's taxes being withheld by the partnership and remitted to the government. Then the individuals, the foreign individuals, normally should file income tax returns because the withholdings is at the highest, for federal purposes, like for individual foreigners, like 37%. Normally that when you file tax return, the rate is actually much lower. So you can get refunds in that case. Okay.
What's the difference between a trust, an LLC, and a corp?
Okay, so the trust, depending on what type of trust, and so there are, for the U.S. tax purposes, and there could be revocable trust, there could be irrevocable trust, and there could be grantor trust and non-grantor trust. So let's say, commonly that for U.S. people here, that we set up revocable trusts, revocable living trust, and that's where we say, oh, do you have a living trust, right? And normally that's a revocable trust. And when you have a revocable living trust, and we put our assets there, and it can be my whole family assets, and those type of revocable trusts are not a separate taxpayer. Meaning that the trust doesn't even get a separate tax ID, and everything I put in there, I still own them. And but the trust itself is more from the avoiding probate purposes. U.S. have this probate when somebody passes away, and essentially we want to avoid probate for a couple reasons. One is it can be very long, lengthy process. It could be expensive because you pay a percentage of your assets as a probate fee to the court. And also that one thing I think is important is if you're going through probate, the assets are considered, the information on your assets are public information, so anybody can access. And so with the trust, and there's no public information, and you can waive probate, and you could have other provisions in there that's to help with the family, the wealth transfer and so far so forth. That's why we normally have a revocable trust first. So there are when it comes to investing in U.S. and real estate, that there could be equity investment through the U.S. LLCs or corporations, whatever, right? Whatever entities we choose, and there could be also portfolio debt. And with the equity investment, this is not a tax. And with equity investment, and you have the potential, right, to participate in the appreciation in value of assets. And but with the portfolio debt and that, or with any debt investment, say I just want to loan money to US, and I don't care about if your property the value will go from $2 million to $20 million. I don't care, and I just want to get my steady 9% return every single year, and I just want to lend money to you. And in that case, is debt investment. So there is a good things about either way. With the equity investment, that if I really put in the capital, I want to participate in the growth, and the foreign investors normally need to file U.S. income tax in this case, and there are withholding tax, which I mentioned before as well, and it could be subject to the U.S. gift and estate tax depending on the structure. But with the portfolio debt, which is a very unique tool, and that's only available to foreign investors, and this is not available to U.S. investors. And period. What that is if it meets the definition, or the documents, the debt debenture documents are drafted appropriately, the debt debenture itself, the interest, portfolio interest, is not taxable to the foreign investors. And is not the normal bank interest is not taxable to foreign investors, but there could be other if, let's say, somebody lend me money to a U.S. corporation and they're getting interest, and if that that document is not like drafted appropriately, does not meet the definition of portfolio debt, that interest could be taxable, right? But this is if it's being drafted properly, attorneys can help you. I do not do the drafting, and that interest, portfolio interest, is not taxable to foreign investors, and there's no tax return needed if they do not have any other U.S. source income subject them to reporting, and is not considered U.S. source income, and is not subject. Let's say I want to gift my portfolio debt to somebody else, and or when I pass away, I hold this portfolio debt. It's not subject to U.S. estate and gift tax, but it's another way for foreign investor to participate. Investing in U.S. kind of like the market, right? I know a lot of I know a lot of actually U.S. Funds have a huge portfolio of foreign portfolio debt investors.
So guys, if you are interested in any of the tax planning, especially if you're a foreigner, you want to come here and invest in especially in U.S. real estate. I'm the real estate guy. She's the tax guy. But if you want to invest in startup companies in Silicon Valley, if you want to put in a VC, if you want to build a family office I can do as well, and so on and so forth. So we're two very good resources to look at. Thank you again so much. I think maybe one of these days we should consider doing this in Chinese. Chinese sucks actually, but yeah.
Yes, absolutely. That's totally fine.
Okay. Thank you so much. Thanks guys. Thanks for watching.